Thanks very much for that, Juliet. We now deliver the Standard Bank news. Standard Bank has released its half-year financial results for the 6 months ended June 2025. The bank reported headline earnings coming in at 23.8 billion rand, that's up 8% on the same time last year, while its return on equity improved to 19.1% compared to 18.5% before. In a statement, it's characterised its performance as strong, while the board has resolved to give shareholders a gross interim dividend of 8.17 rand a share. That's up 10% on last year. Well, to give us the backstory to the numbers, I'm joined by Sim Tshabalala. He's the Group Chief Executive at Standard Bank. Thanks very much, Sim, for joining us. So your total net income was up 7% at 94.7 billion rand in the period under review. What were the main drivers behind that right across your business divisions in South Africa and elsewhere? And other earnings you've reported to the market in line with what you'd expected?
Thank you very much, and it's a great pleasure to be chatting to you. The drivers of our performance were principally, firstly, a big balance sheet. So the Standard Bank has got a big lending book, and the fastest growing part of that has been our corporate and investment banking lending book, which was up by about 12%. So we're lending to corporates, and these corporates were doing activities associated with energy, logistics, non-bank financial institutions, and so forth. Secondly, slower growth in our balance sheet arising from consumers, principally home loans, vehicle and asset finance, and unsecured lending. And then a large part, though, of the fees and commissions and non-funded revenues came in the nature of great activity in South Africa, where we're doing more with our clients, a larger customer base, resulting in fees and commissions growing by about 11% in South Africa. An important driver also was trading revenues, where we help our clients protect themselves against interest rate movements or foreign exchange risks or commodities risks or equities risks. That business did exceptionally well both in South Africa and in Africa regions. If I could just take another perspective, another look, South Africa did not grow as fast as our operations outside South Africa. This was a half during which our businesses in Africa regions, which is the businesses outside South Africa, grew significantly faster. And that in large measure was because, firstly, of greater activity, particularly in West Africa, but also because the foreign exchange losses that you and I spoke about last year did not recur to the same extent this half. The difference between the rand outcomes and the local currency outcomes were about 3%. Perhaps let me stop there.
Okay, Sim, thanks for that. Let's get into how the consumer is faring, especially when looking at issues around credit default and the like.
The consumer is having a tough time, to be honest. So if we start with lower LSMs, people are struggling, job losses, suffered high interest rates and high inflation in the last couple of years. There's been an abatement, of course, in interest rates, the cutting of interest rates by the central bank, but people have struggled to meet their obligations as they fall due. As you go up the wealth structures of the country, people are doing better. There's less difficulty with people paying their loans at the top end of the market. But even there, people are starting to find it difficult. We've noticed that people are drawing down on their two pots. They are withdrawing their savings in order to repay their loans. So there's a tough one. However, in the case of Standard Bank, what we've seen a combination of people benefiting from the declining interest rates. We've seen people benefiting from sustained jobs, particularly at the top end of the market. And we've seen a more disciplined approach to debt recovery in Standard Bank, resulting then in NPLs slowing down in their growth, but also people failing to meet their obligations as they fall due at a slower rate than they did during the same period last year. Put differently, bad debts have slowed down And that is showing up in that credit loss ratio of 93 basis points.
Yeah.
Perhaps let me stop there.
That's positive. So in the statement that you issued to the market, you refer to the macroeconomic backdrop, and you make the comment that the Reserve Bank's announcement around its preference to focus on the lower end of the inflation target range, that is 3%. You suggest there that this might cloud the outlook for the economy beyond 2025. Just elaborate on what you meant.
Essentially, the authority to determine the target range is that of the Ministry of Finance, and the authority to use the instrument, in other words, interest rates, is that of the central bank. There's been confusion in the market about whether the target remains at between 3 and 6%, and therefore the target is actually 4.5%, or whether it is now 3% as announced by the central bank. The challenge with that, of course, is that if it is 3%, the authorities may need to be more hawkish, for want of a better word, and therefore keep interest rates at the same levels or even hike them next year in order to manage inflation at 3% and below. Whereas our assumptions, and in the way we've calculated our planning and our base case, has been on that range of between 3 and 6%, and therefore a target of 4.5%. And the same would apply to the market players. They would all have a similar analysis. One other thought is the fiscal authorities would be planning on the basis of 4.5%, and if the target has changed and they now need to be planning at 3%, when do they start doing that? And I suppose those would be the issues that would cause a challenge.
Yeah. Sim, I have so much more to ask you, but unfortunately we don't have enough time. But thank you so much for having spoken to us. That was Sim Tshabalala. He's the Group Chief Executive at Standard Bank.